Some of the greatest moments of wealth creation in humanity have come from investors who have made the right bets at the right time in venture capital deals, backing some of the most transformational tech companies of our time. But what are the best deals of all time? Deals that have given the biggest return to the early investors who had the vision and conviction to place capital when others may not have. That's exactly what we'll explore today to understand the circumstances around the best venture capital deals of all time. In 2014, Facebook bought WhatsApp for an eye-watering $22 billion. This wasn't just big news because of the huge numbers involved. It was a landmark moment for Sequoia Capital, the only venture capital firm to invest in WhatsApp. Their initial $60 million check turned into $3 billion. You see, Sequoia Capital had a unique approach. Instead of inviting lots of investors to join the party, they chose to go it alone in backing founders Brian Acton and Yan Koum. They were the only backers in WhatsApp's early funding rounds, starting with $8 million in 2011. And Sequoia continued to be the sole supporter of later funding rounds too. Sequoia believed in WhatsApp's potential, even though it wasn't making much money yet. This belief was strong. While other companies like Twitter spread their shares among many investors, WhatsApp kept it simple with just Sequoia on the cap table. This move paid off massively when Facebook stepped in with its massive purchase offer. But Sequoia's big win wasn't just about the money. It was also sweet revenge for the investors. 10 years before the WhatsApp deal, Facebook's Mark Zuckerberg had rudely snubbed Sequoia, showing up late for a meeting in pajamas just to say he wasn't interested in their investment. Fast forward, and Sequoia's investment in WhatsApp not only brought in billions, but also proved they could spot a winning deal, even if it meant betting on a company Facebook would eventually need to own. But what about Facebook itself? It has a legendary story and is amongst one of the most valuable companies in the world. Facebook's journey from a college project to a global powerhouse is nothing short of spectacular, with a twist of missed opportunities and massive gains for the early believers. Back in 2005, when Facebook was just stepping out as the Facebook, Accel partner Jim Breyer saw something special. Under his direction, Accel decided to invest $12.7 million in a Series A funding round, grabbing a 15% slice of the company. At that time, Facebook's value was set at a hefty $87.5 million, a figure that would raise eyebrows in the valley. Fast forward to 2012, and Facebook's public offering set the stage for a staggering $104 billion valuation. For Accel partners, their early bet turned into gold, with their shares valued at $9 billion. This investment is hailed as one of the most successful in the venture capital world. However, not everyone saw Facebook's potential from the get-go. Peter Thiel, the very first investor in Facebook, passed on the chance to invest alongside Accel. He initially invested $500,000 when Facebook was just finding its feet amongst college students. Thiel believed the company was overvalued when Accel stepped in with their investment, a decision Peter Thiel would later come to regret. Thiel's hesitation was based on a common mistake: underestimating exponential growth. In his own words, people often expect life to progress linearly and fail to recognize when something is set to explode in value and impact. Facebook's growth was explosive, quickly outpacing Thiel's expectations and showing that Accel's overpayment was actually a bargain. This story illustrates the importance of vision and conviction in the venture capital world. While it's easy to misjudge a company's value, the success of Facebook underscores the potential rewards of backing a startup through thick and thin, especially when its growth defies conventional expectations. As investors and entrepreneurs alike learned from Facebook, sometimes the riskiest bets are the ones that redefine our understanding of success. And the same is true for our next VC investment. Snap Inc. is a story that proves looking beyond first impressions can lead to monumental success. When Snap went public in 2017, it grabbed headlines with its massive $25 billion valuation, marking a significant moment for its early investors, Benchmark Capital and Lightspeed Ventures. Lightspeed was the first to spot Snap's potential, investing around $8 million early on, which ballooned to an impressive $2 billion at the IPO. Benchmark followed, leading Snap Series A with a $13.5 million investment, guided by partners Matt Kohler and Mitch Lasky. Lasky in particular formed a close bond with Snap's founder Evan Spiegel, mentoring him through the startup's ups and downs. But Snap's journey wasn't smooth sailing from the start. It faced skepticism and was often dismissed as a fleeting trend among college students. Many couldn't see past its reputation as an app for sending disappearing photos, some of which were risque. Yet Benchmark and Lightspeed saw the bigger picture. They recognized Snap's potential to stand alongside giants like Facebook and Twitter in the social media realm. Mitch Lasky and his team at Benchmark believed Snap was more than its public image. They saw a platform with the power to change how people communicate. Despite the controversy surrounding the app's early days, Benchmark envisioned Snap evolving into a major player in mobile technology, drawing parallels to their early investment in Instagram. The skepticism wasn't without its reasons. Many investors, including Mark Suster from Upfront Ventures, hesitated to back Snap due to its association with negative use cases. However, Snap's true potential began to shine through when they noticed unexpected user engagement patterns, like spikes in activity during school hours at a high school in Orange County. This insight revealed Snap's appeal as a modern-day tool for students to connect, akin to passing notes in class. Snap's ability to transcend its initial perception and become a staple in daily communication highlights the importance of vision in the venture capital world. It teaches us that sometimes the most transformative ideas come from the most unexpected places, challenging investors to look beyond the surface. But not all the best VC returns happen so quickly. In some instances, it can be a long journey before the conviction pays off. And this was exactly the case with King Digital Entertainment, often known simply as King, has made a big splash in the world of video games. They're the brains behind some of the most addictive social games out there. The Candy Crush saga is their biggest hit, and also perhaps something you've also played. Back in 2012, King decided to sprinkle a little sweetness into the gaming world, and this game became an instant hit, grabbing 14 million downloads in its first week alone. Today, 250 million people still play a Candy Crush saga every single month. It's like an entire country of people can't stop matching those candies. So how did King go from a regular game developer to a household name? Enter Apex Partners, a venture capital firm with a knack for spotting potential. In 2005, King was struggling, but Apex saw something special. They decided to invest $36 million for a 45% share of the company. It was a big gamble, but one that paid off big time. Thanks to Candy Crush, King's popularity skyrocketed. They went from being on the edge of bankruptcy to having 97 million people playing their games every single day. And it wasn't just Candy Crush Saga. They kept the hits coming with games like Candy Crush Jelly Saga and Candy Crush Friends Saga, each making a splash in their debut weeks. And the cherry on top, in 2014, King went public, and Apex's early investment turned into a staggering $3.6 billion. That's a return of 100 times their initial investment. Meanwhile, Index Ventures, another investor, made a handsome profit too, turning an 8% stake into $560 million. But there is one tech deal that has now cemented its story into the legend of the tech industry, for the beast it went on to create and the returns it provided its early backers. In the late 90s, a visionary Andy Bechtolsheim, co-founder of Sun Microsystems, saw extraordinary potential in a project by two Stanford PhD students. With a prescient move, he wrote a check for $100,000 to an entity that didn't yet exist. That entity would go on to become Google. This initial investment in 1998 sparked the beginning of a tech giant, even before Google was officially a corporation. Following Andy's initial faith, Google's appeal to investors grew, leading to a significant Series A funding round in June 1999. This round raised $25 million from some of the most prestigious names in venture capital, including Sequoia Capital and Kleiner Perkins, with contributions from celebrities like basketball star Shaquille O'Neal and Hollywood action hero Arnold Schwarzenegger. Even Jeff Bezos, the founder of Amazon, joined as an early believer, injecting $250,000 into Google. These early investments were the seeds that sprouted into one of the most phenomenal growth stories in the business world. By the time of Google's IPO in 2004, these initial stakes had multiplied in value beyond what many could have imagined. For instance, Bezos' early investment translated into 3.3 million shares of Google stock, worth over $280 million at the time of the IPO. Today, the value of these early investments has skyrocketed even further, illustrating the monumental returns that visionary early-stage investing can achieve. Andy Bechtolsheim's initial $100,000 has grown exponentially to over $1.5 billion at the time of Google going public, highlighting the incredible impact of backing the right idea at the right time. This tale of foresight and faith in innovation shaped the destiny of Google and redefined venture capital investment strategies worldwide. The tech industry continues to change the world with innovation that impacts all our lives. And in the process, it continues to mint billionaires who have the network and early conviction to back fledgling businesses that often have no more than just a crazy idea and a founder belief that they can change the world. Thanks for watching.